5 business days. That is all that separates the silver market from April's first notice day on COMEX, and right now 1,227 contracts representing 9.6 million ounces of physical silver are still sitting open with nowhere to hide. The registered vaults have been bleeding for months, the coverage ratio just hit 14.2%, and the paper leverage sitting on top of that shrinking pile of real metal has ballooned to 7 times the amount of silver that can actually be delivered. 5 days. Let that number follow you through everything I'm about to show you, because by the time you reach the end of this video, you will understand why those 5 days could change the trajectory of the entire precious metals market for the rest of 2026. This is OG John AG. If you have been watching this channel, you already know the system is fracturing. If you are new here, hit subscribe and join a growing community of people who refuse to accept headlines at face value. What I am about to walk you through today is the most complete breakdown of where silver stands right now, on March 24, 2026, using nothing but the freshest data available as of this moment. No recycled narratives, no last month's numbers dressed up in new clothes. Everything you are about to hear is happening in real time. The 52-week range on silver futures right now stretches from $29.11 to $121.78. That is a 318% spread. No other major commodity on the planet has a range that wide. Not oil, not copper, not gold. That kind of volatility does not happen in stable markets. It happens in markets that are being pulled apart by two opposing forces, one visible and one invisible, and the visible one is losing. JP Morgan's official research desk sees silver averaging $81 per ounce in 2026, more than double the 2025 average. But their former chief strategist Marko Kolanovic is publicly calling for a crash back to $50, calling the rally a meme-driven mania. The same institution is projecting two contradictory outcomes. That alone should tell you something about how broken the consensus is right now. Let me start with what the screen says versus what the vaults say, because those two things have completely divorced from each other, and nobody in mainstream financial media wants to explain why. Spot silver opened today at $70.13 per ounce. That is a 74-cent uptick from yesterday's close and a $37 gain compared to where it was exactly 1 year ago. Sounds healthy on paper. But zoom out just 12 days and the picture changes violently. On March 12th, silver was trading at $87.33. 6 days later, on March 18th, it had fallen to $77, shedding over $3 in a single session. Then March 19th happened. A 10-to-84 single-day crash dragged the price down to $66.693. That is not a normal correction. That is a controlled demolition. The next day it snapped back $5.17 to $72.10. Proving that the sell-off was not driven by fundamental weakness, but by forced liquidation. And now here we sit at $70.13, more than $17 below where we were less than 2 weeks ago. The 50-day moving average sits at $80.02. The 200-day moving average just got sliced through at $73.16. Sellers have taken technical control of the market, but the technical picture is only half the story. The other half is buried in the vault reports that most retail investors never look at. COMEX registered silver, the metal that actually backs the futures market and enables physical delivery, has declined 10.8% in just the last 30 days. That is 9.6 million ounces pulled out of the system in 4 weeks. Registered stocks dropped below 90 million ounces back in February, and total COMEX inventory has cratered nearly 31% since October 2025, falling from roughly 532 million ounces down to approximately 366 million. To put that in context, registered silver has now declined over 70% from its 2021 peak. 7 out of every 10 ounces that once sat in those vaults are gone, and the metal that remains is not all freely available. A portion is already allocated, pledged as collateral, or held by custodians who are also the beneficial owners and have zero obligation to release it. Think of it like a bank account showing $100,000, but $50,000 is earmarked for a mortgage, $20,000 is pledged against a credit line, and $15,000 is under a judgment lien. The headline says $100,000, the operating reality is $15,000. Some analysts estimate that the truly unencumbered silver in COMEX vaults could be dramatically lower than the headline number suggests. The February data from Seeking Alpha confirmed that registered metal saw a large decline, and instead of flowing into the eligible category, it left the vault entirely. This is a market in backwardation, facing record prices, high demand, and metal physically departing the warehouse system. That is not a correction. That is a structural drain. So if physical supply is this tight, why is the paper price collapsing? Hold that question. The answer is worse than you think. On March 19th, CME Group hiked margin requirements on silver futures. The stated reason was to curb volatility. The actual effect was the opposite. Leveraged traders who were already stretched thin were forced to either wire fresh collateral within hours or dump their positions into a falling market. The iShares Silver Trust, the largest silver ETF in the world managed by BlackRock, recorded its biggest single-day outflow in over a decade on that same date. A new SEC regulation requiring 100% allocated physical backing certification compounded the pressure. This was not a market finding fair value. This was a liquidity event manufactured by the intersection of margin mechanics and regulatory timing, and it triggered a cascade that took silver from 92.70 all the way down to the 60s in less than a week. But March 19th was not even the most violent day silver has seen in 2026. That title belongs to January 30th. Silver had been surging through the month, riding a wave of physical demand, Chinese buying, and tariff uncertainty. It touched $107 on a Wednesday. By Thursday, it was flirting with $120. Then on Friday, it cratered 35% in a single session, falling to roughly $78. That is the worst one-day silver crash since 1980. Multiple analysts called it a Six Sigma event, the kind of statistical anomaly that is only supposed to happen once in millions of trading days. The Citigroup research desk had estimated that $6.8 billion in silver futures would be sold during the first 2 weeks of January due to the annual Bloomberg Commodity Index rebalancing. Because silver had surged over 140% in 2025, its weight in the index had become too high. Citi's strategists publicly stated they had never seen any outsized flow like this one in years of running the process. By calling the move never before seen and outsized, they helped catalyze the selling stampede before the crash even arrived. And what happened on that exact Friday? According to multiple reports and market commentators, JP Morgan appeared to close its silver short position almost perfectly at the intraday bottom. The London Metal Exchange went dark, HSBC's systems went offline, and CME had already hiked silver maintenance margins to $32,500 just days earlier, thinning out liquidity before the hammer fell. Critics described it as an engineered flush. Supporters called it coincidence. The CFTC has not announced any new investigation, but the data points line up in a way that demands uncomfortable questions. This is the same JP Morgan that paid a record $920 million fine to the CFTC for spoofing and manipulation spanning at least 8 years from 2008 to 2016. Hundreds of thousands of fake orders placed across precious metals and treasury futures to deceive other market participants. 2 of their traders went to federal prison. The head of their global precious metals desk received a conviction. And yet estimates now place JP Morgan's physical silver stockpile at over 750 million ounces, most of it accumulated between 2012 and 2019 when silver was stuck in the $14 to $20 range. They built the largest private silver hoard since the Hunt brothers while the price was suppressed. Now the price is exploding, and whether they are net long or net short at any given moment, they hold enough metal to move the entire market in either direction. In a moment, I'm going to show you a data point that recontextualizes everything I just said about the paper market. But first, I need to take you to the other side of the world. On January 1st, 2026, China implemented the most significant precious metals policy shift in a generation. The Ministry of Commerce replaced the old quota system with a strict licensing regime for silver exports, effective through 2027. Under the new rules, only companies with annual production capacity of at least 80 tons and substantial credit lines can qualify. The government released a list of just 44 approved exporters. Hundreds of smaller and mid-sized firms that had been key suppliers to global industrial users and refineries were locked out overnight. China controls between 60% and 70% of the world's refined silver supply. Even a partial restriction creates an immediate global supply shock. State-run Securities Times cited an unnamed industry insider saying the policy elevates silver from an ordinary commodity to a strategic material, placing its export controls on the same regulatory footing as rare earth metals. Elon Musk reacted publicly on X, stating this is not good and that silver is needed in many industrial processes. He was not exaggerating. Silver is irreplaceable in solar panels, semiconductors, 5G infrastructure, electric vehicles, AI data center power systems, and advanced medical devices. There is no viable short-term substitute at industrial scale. And remember what happened the last time Beijing played this game. In 2010, they started licensing rare earth exports, not banning them, just requiring paperwork, approvals, and quotas that somehow never quite met demand. The effect was surgical. Prices spiked up to 4,500%, and Western manufacturers discovered they could not build smartphones or missiles without Chinese permission. The rare earth squeeze was not dramatic. It was bureaucratic, death by 1,000 forms. Silver is now on that same trajectory. Metals Focus forecasts that even with higher prices, mine supply growth will remain modest with only minimal increases globally. Global mine output has been declining since peaking in 2016. There is no quick fix. There is no new mine coming online next quarter to solve this. The deficit is structural, and the export curbs from China just turned a long-term shortage into an immediate crisis. Here's the data point I told you to wait for. The March 2026 COMEX silver futures contract alone represented 528 million ounces of exposure across 105,683 contracts. Against that, only 113 million ounces of registered silver existed. That is more than 4 times the deliverable supply concentrated in a single contract month. The system only functions because most traders never ask for delivery. They roll, they close, they settle in cash. But in January, something changed. Delivery demand for that minor month hit 33 to 40 million ounces in the first 2 weeks alone, a 7 to 10 times increase over historical January averages. Traders were rolling contracts backward from March into January and February to take immediate delivery. That is the opposite of normal market behavior. It signals urgency to secure physical metal before the inventory shrinks further. On January 7 alone, JP Morgan issued 99% of 8.1 million ounces in delivery notices. And despite those massive deliveries, open interest in January actually increased by 1,231 contracts. New buyers were piling in faster than metal could be delivered out. Meanwhile, the physical market told a completely different story than the paper screens. Reports circulated that physical silver was clearing at $130 per ounce in Japan and the UAE, while COMEX spot sat at $72. An 80% premium. Shanghai Gold Exchange premiums reached 12% to 13% above LBMA and COMEX benchmarks, among the most extreme divergences in the modern silver market. In Raikot, India, the divergence was lethal. 44 silver trading firms declared insolvency with combined liabilities approaching $425 million. They held paper positions, not physical bars. When CME hiked margins, they were wiped out in hours. The physical market is screaming that silver is worth far more than what Western exchanges are printing on screen. Pull up the Shanghai premium data right now while this video is playing. Compare it to the COMEX spot price. Tell me those two numbers belong in the same market, because they do not. Now let me talk about what is happening geopolitically as of today, March 24th, because this is the variable that just reset the entire macro framework. The Strait of Hormuz has been closed. Brent crude has surged above $103 per barrel. Missile strikes on Qatar's Ras Laffan industrial city damaged LNG production trains, causing a 17% reduction in Qatar's export capacity. Qatar Energy declared force majeure on long-term contracts. The shockwaves hit East Asian manufacturing hubs immediately. Energy-intensive industries that consume massive amounts of silver, particularly solar panel manufacturing and semiconductor fabrication, are now staring at rising input costs that could destroy demand at the margins. Leading up to this crisis, silver had been supported by a massive 790 tons of imports surging into China during the first 2 months of 2026. But as energy costs spike, the narrative has shifted from supply scarcity to demand destruction. That shift is what gave the bears their opening. The energy shock is feeding directly into inflation expectations, and the Federal Reserve has responded by signaling only one rate cut for the remainder of 2026. Real yields are climbing, the dollar is strengthening, and silver, which pays no yield, has become expensive for institutional holders to carry. That is why institutions are selling, not because the physical story changed, not because demand collapsed, but because the cost of holding a non-yielding asset just spiked while energy prices are rewriting the inflation calculus. Everyone is now watching the March 27 PCE inflation data for the next directional signal. If it comes in hot, the Fed may not cut at all this year. If it comes in soft, the dollar weakens and silver catches a bid. 3 days until that number drops, the gold-silver ratio has widened to 65 to 1, up from 59 to 1 earlier this year. Historically, when that ratio stretches during a correction, silver tends to violently outperform gold in the recovery phase. The question is whether this correction is finished or whether another leg down is coming first. But I owe you the bearish case, and I am going to give it to you straight because this channel does not deal in echo chambers. The bears have real arguments, and ignoring them does not make them disappear. Silver's 52-week range spans from $29 to $121, a 318% swing that screams speculative excess. Marko Kolanovic, the former JP Morgan chief strategist, has called for silver to trade back toward $50, describing the rally as a meme-driven mania destined to unwind violently. He points to the 1970s precedent when gold surged from $40 to $200, crashed 50%, shook out every weak hand, and then ran to $800. His argument is that silver behaves less like a store of value and more like a leveraged macro instrument, and leveraged instruments snap back hard. The March 19 CME margin hike and the SLV outflow event support his thesis. Institutional money is leaving. ETF flows have turned negative. If the Iran situation de-escalates and oil drops, the Fed could turn dovish again, but that would also remove one of silver's safe haven catalysts. The counter-argument is real. If you ignore it, you are not investing. You are gambling. But here is what the bears have to reconcile. The cumulative global silver supply deficit since 2021 now stands at approximately 820 million ounces. That is nearly a full year of total global mine production that has simply vanished from above-ground stocks. 2026 marks the sixth consecutive year of structural deficit. Global demand hit 1.24 billion ounces in 2025 against total supply of just 1.01 billion, a 230 million ounce gap. Mining output has plateaued since peaking in 2016 and is not expected to meaningfully increase despite record prices. London Vault holdings have lost roughly 40% of their silver. Shanghai Gold Exchange inventories crashed to just 450 tons as of February, a 91% decline from the 5,280-ton peak in 2020. Sprott Physical Silver Trust doubled its capital raise to $2 billion on January 20th, signaling institutional conviction about physical silver at scale. At current prices, that single move could absorb 18 million ounces, roughly 16% of what remains in COMEX registered vaults. Covered silver producers and royalty companies are pricing an average silver price of $122 per ounce, dramatically higher than today's $70 spot. The smart money is not selling physical silver. The smart money is accumulating it while the paper market gives them a discount. London tells the same story from a different angle. Approximately 600 million ounces of silver trade daily through the London market, implying promissory note claims of 1 to 2 billion ounces against a vault float that has held stubbornly at around 140 million ounces since late spring 2025. The one-year lease rate has surged above 5%, a level that signals intense physical shortage. When lease rates spike alongside rising prices and static vault holdings, the market is telling you that holders of real metal are refusing to lend it. They know what it is worth. The free float in London may be approaching zero. Reports confirmed that logistics operators were attempting to relocate between 15 and 30 million ounces from New York COMEX vaults to London just to satisfy demand. That is metal being physically moved across the Atlantic because London cannot source it locally, and here is the part that should concern anyone holding a silver ETF. Most silver ETFs do not operate like simple vaults holding unencumbered metal for shareholders. They rely on authorized participants, custodians, sub-custodians, and leasing arrangements. Under normal conditions, this functions smoothly. Under physical stress, it does not. When lease rates rise and physical silver becomes scarce, authorized participants may be unable to source metal for ETF creation or redemption. Shares continue trading, while the underlying metal effectively disappears from the market. Investors believe they own silver. In reality, they hold a paper claim with growing counterparty risk. That is how paper markets break, not through a single dramatic default, but through gradual loss of credibility as physical metal flows out of Western vaults and into regions willing to pay real premiums for actual bars. Everything I have shown you about the paper market, the margin hikes, the crash from $87 to $60 in 12 days, the ETF outflows, all of it assumes one thing. It assumes the physical market will continue to accept paper settlement. It assumes Shanghai will keep tolerating a 13% premium without pulling more metal out of Western vaults. It assumes China's 44 approved exporters will keep shipping. It assumes COMEX can navigate April's first notice day with 14.2% coverage and 7x paper leverage without a single delivery failure. 5 business days. That is what sits between the current calm and a potential delivery crisis that could force COMEX into cash settlement on a major contract month. If that happens, the paper price becomes irrelevant. The physical price becomes the only price that matters. Most people watching financial news tonight will see a headline that says, "Silver fell 45% from January highs," and assume the trade is over. They will not look at the vault data. They will not check the Shanghai premium. They will not know that registered COMEX silver could be exhausted in 182 trading days at the current withdrawal pace. They will not know that China just turned silver into a strategic weapon. They will not know that JP Morgan holds 750 million ounces while retail traders get margin called into oblivion. But you know. You just watched every data point. You followed the math from vault to vault and exchange to exchange. And that puts you in a position that 99% of market participants will never occupy. If this breakdown gave you clarity, share it with one person who needs to see it. Hit subscribe if you want to stay ahead of the paper illusion. And if you made it all the way here, drop a comment that says OG John AG 2.0 so I know exactly who watched every second and who skipped to the end. This is OG John AG reminding you to trade with logic, act on data, and never let someone else's narrative replace your own research. The vaults do not lie, neither do I. Stack wise, stay sharp.